Hi, welcome to Pauline Yong's channel. If you like our videos, please click the like and the subscribe buttons. Also, please comment below to submit your area of interest and we will cover for you. In this video, as promised, we are going to cover the transportation and logistics sector and rank this sector's stocks according to their market capitalization. The transportation sector is a category of companies that provide services to move people or goods as well as transportation infrastructure. The transportation sector consists of several industries including air freight and logistics, airlines, marine, road and rail, and transportation infrastructure. So let's take a look. We rank the Bursa Malaysia transportation and logistics stocks according to their market capitalization. Top of the list is the MISC BERHAD with a market capitalization of 27.8 billion. MISC BERHAD is a Malaysian-based company which is a provider of energy, shipping, and maritime solutions. The company is engaged in the shipping and its related activities, owning and operating offshore floating solutions, marine repair and conversion, engineering and construction works, maritime education and training, as well as owning tank terminals. We like MISC due to the following reasons. Heavy engineering rebounded. The heavy engineering segment of the MISC recorded revenue which is 135% gain year-on-year and 48% gain quarter-to-quarter for third quarter financial year 2020. This higher revenue in the current quarter can be attributed to the resumption of yard activities given its suspension during the MCO in the preceding quarter. As of third quarter 20, the segment has achieved quite significant milestones for this year. First, completed repair and maintenance of 38 vessels. Number 2, it secured 44 jobs. And thirdly, completed the conversion works for FSO Golden Star. However, in terms of the MISC fundamental, it is currently having negative earnings due to a huge quarterly loss registered for the first quarter of 2020. The first quarter as at March 31st, 2020, quarterly loss was 1.1 billion, which represented 562% drop in profitability as compared to the previous quarter. Subsequently, the second and the third quarterly profit has turned positive, but overall, it will take at least 4 quarters of earnings to reverse the negative earnings. Despite the quarterly loss, the fundamental is still intact with dividend yield of 3.3%, price-to-book ratio of 0.82, cash reserve of 6.8 billion ringgit, and the debt-equity ratio of 0.4. Being one of the KLCI 30 component stocks, this stock is always the fund manager's favorite. The second highest market capitalization in the transportation and logistics sector is the Westports Holding BERHAD with a market cap of 14.3 billion ringgit. Westports Holdings BERHAD is a Malaysia-based company which is principally involved in the investment holding and provision of management services to its subsidiary, namely the Westports Malaysia Sdn BERHAD. The company primarily manages port operations dealing in container and conventional cargo. The segment has bounced back and shall do even better in 2021, as evidenced in the record high Shanghai Containerized Freight Index (SCFI), often used to gauge the health of global trade. We believe the pandemic as well as trade tensions between major economies in the world prior to the pandemic are reshaping the global supply chain, resulting in a diversion of investments from China to the Southeast Asian region, thus boosting container throughput in the region. The container throughput growth in the region is also supported by fast-growing sectors such as communication equipment, semiconductors, textile and apparel, as we are home to many suppliers for the industries in this region. In terms of the Westports Holding financials, it has a very strong profit margin of 32.7%, the ROE 23%, and a good dividend track record of 5%. Its quarterly earnings also have positive trends with third quarterly earnings of 204 million ringgit, which was even higher than its pre-pandemic profits. However, management is expecting a low single-digit decline in terms of overall container throughput this year, estimated between -3 to -5%, which is equivalent to 10.31 million to 10.53 million TEU in comparison to last year. TEU refers to the specific unit used to measure the cargo capacity. In addition, the group is faced with additional tax liabilities of 120.6 million from IRB last year. Since then, Westport has contested against the IRB's imposition of an additional tax assessment. The management believes that the tax liabilities will not have material impact on the group's financial performance, as they are sitting with a cash reserve of 610 million ringgit. Rank number 3 is the Malaysia Airports Holding Berhad, with a market capitalization of 8.4 million ringgit. The Malaysian Airports Holding Berhad is an investment holding company. The company operates through the segments, which includes Malaysia operations and the overseas operations. We like Malaysia Airport because of the opening up of economy post-COVID-19. According to the IATA, the passenger volume will not return to 2019 levels until 2024, with domestic markets recovering faster than the international services. But on a brighter note, it is assuming that borders will start reopening by mid-2021 with testing and the growing availability of vaccine. Because of the pandemic, the Malaysia Airports Holdings Berhad has since suffered negative earnings right from the first quarter 2020 with negative 20 million ringgit till the third quarter with negative 320 million ringgit. The annual earnings have seen a sudden drop also due to the pandemic. As we can see, if not for the pandemic, Malaysia Airport could have a steady rising revenue trend. Its fundamental is intact, with price-to-book ratio of 0.95, dividend yield 2%, cash reserves 782 million ringgit, and low debt equity ratio of 0.48. We believe the recovery of the airline industry will take about minimum 6 months from now. Hence, the earnings for the Malaysia Airport will not be getting better until the fourth quarter of the year. Hence, investors might have to be patient for this stock. Rank number 4 is the MMC Corporation Berhad, with a market capitalization of 2.4 billion ringgit. MMC Corporate Berhad is a Malaysia-based investment holding, construction mining, and mineral exploration company. MMC operates through 3 segments: energy and utilities, ports and logistics, and engineering and construction. Its engineering and construction segment is engaged in the infrastructure and construction projects, and its other segment is engaged in the investment holding, airport operations, and water treatment operations. Below are the reasons why we like MMC. Currently, MMC's book order stands at 3.3 billion ringgit, with the biggest portion deriving from the MRT2 projects. However, despite the good size of its order book, the visibility of the contract is only until first quarter of 2023. Upon the expiry of the Langat Sewerage project, management guided that replenishment is on its way, as they are bidding approximately 5 billion worth of contracts, which includes projects related to water treatment plant, gas pipelines, jetty expansion, Putrajaya Rail, and the KLIA projects. In addition, based on our observation on the MMC's port statistics, the Pelabuhan Tanjung Pelebas (PTP) has managed to grow its TEU's volumes despite the trade turbulence due to the pandemic. PTP has recorded 7.07 million TEUs for the year-to-date 9 months for financial year 2020, or a positive gain of 5% year-on-year growth. In contrast, other major ports in the MMC's stable are not faring well for the current year. In terms of the container volumes for the 9 months financial year 2020, Penang Port recorded highest decline at -7% year-on-year, followed by the North Port at -6% year-on-year, while Johor Port showing the least decline in TEU's volume at only -3% year-on-year contraction. Currently, MMC Corporation was trading at 79 cents as at 25th of January 21. It has a PE ratio of 9, net tangible assets of 3.08, and a cash reserve of 1.2 billion. However, the company's annual revenue has been seen declining steadily from its peak in 2014. It also has weak profit margin of 6.15% and an ROE of 2.8%. What is commendable is that quarterly earnings were maintaining despite the COVID-19 pandemic. Their Q2 quarterly earnings was 14.9% higher than the previous year. Rank number 5 is the GDX Express Carrier Berhad or GDEX with a market capitalization of 2.1 billion ringgit. The company, through its subsidiaries, is engaged in the provision of express delivery services, logistics services, and property investment holding. We like GDEX is because the parcel delivery segment will continue to be the winner even post-pandemic, as we believe consumers have permanently shifted their shopping habits from physical stores to online channels, lifting the growth path for parcels volume to another new level. The National Postal and Courier Industry Lab (NPCIL) is set to strengthen the industry, and this will benefit all existing players, especially those that already have strong footprint in the country, like GDEX and Post Malaysia. GDEX is currently trading at 38 cents as at 25th of January 21. Its PE ratio was as high as 100 times, profit margin was low at 5.4%, and its ROE was 4.2%. However, one positive note about its fundamental is that GDEX has a zero debt-equity ratio. In addition, its quarterly revenue has been on a rising trend, despite in the midst of the pandemic. Rank number 6 is the LINGKARAN Transportation Holding BERHAD, LITRAK, with a market capitalization of 2.1 billion. Lighttrack is engaged in the investment holding and the provision of management services to the subsidiaries. The principal activities of the subsidiaries are to design, construct, operate, and maintain Lebuh Raya Damansara Puchong (LDP) and to manage its toll operations and investment holding. The government operates through segments including highways and others. We like Lighttrack is because of the revenue from the toll highways. In January 2020, the government had announced the continuation of the freeze on the toll hike for 2020. For Lighttrack, toll rates on the LDP and Spring Highway will remain unchanged, and the compensation payable by the government will be determined accordingly as stipulated in the concession agreements. To note, there will be no more scheduled toll increase for the LDP and the Spring Highway. However, there will be still one last scheduled rate increase for the Spring Highway's Damansara Link and the Kerinci Link in 2022. Despite the toll fee freeze, we like the stability of the revenue stream from the toll highways. Lighttrack has a solid fundamental with profit margin of 51.3%, PE ratio 9, ROE 19.8%, dividend yield of 6.3%. The company also experienced rising revenue trend despite the pandemic. In fact, even though the country is implementing the Restricted Movement Control Order (MCO), but this did not affect the transportation and the logistics sector because this sector was not in the lockdown list. Hence, their business carried as normal during the MCO. Next, rank number 7 is the Bintulu Port Holding BERHAD with a market capitalization of 1.8 billion ringgit. Bintulu Port Holding BERHAD is an investment holding company. The company operates in two segments, port operations and bulking services. The port operations segment is engaged in the port services and construction services, and the bulking service segment provide bulking installation facilities for palm oil, edible oils, vegetable oils, fats, and its byproducts. We believe there are opportunities for the Bintulu Port due to the following reasons. Demand for aluminium and alloy products is rising, especially from China, Korea, Japan, Turkey, and South Africa, and there has been reflected through plant operations in the Samalaju Industrial Park operating at close to 90% of their capacity. To meet the growing demand, one of the operators, Press Metal, will be commissioning a new plant by Q4 2020 that will bring its total smelting capacity to 1.08 million tons. From a power infrastructure standpoint, the state of the Sarawak is well prepared to fulfill the needs of these energy-intensive industries, especially with the clean and renewable energy produced through the Sarawak Corridor of Renewable Energy (SCORE). This key factor will also help to boost the sustainability credentials for the Bintulu Port users going forward. The International Maritime Organization (IMO) has introduced new limits that compel ships to use marine fuels with a sulfur content of no more than 0.5%, significantly lower than the previous limit of 3.5%. This regulation came into force effective 1st of January 2020 and represents an ongoing effort by the IMO to protect the environment and to reduce air pollution. This will effectively force ships to shift from using high sulfur content fuel to lower sulfur content fuel. For the group, The opportunity lies in the proximity of the Bintulu Port to the LNG and other lower sulfur content fuels for the bunkers. We like Bintulu Port is because of its strong fundamental. Currently, Bintulu Port holding is trading at 3 ringgit and 90 cents as at 25th of January 21, with a P/E ratio of 16, ROE 8%, profit margin 15.8%, and a strong dividend yield of 8%. Rank number 8 is Post Malaysia BERHAD with a market capitalization of 806 million ringgit. Post Malaysia BERHAD is engaged in the providing of postal and related service. The company operates through 3 segments: mail, courier, and retail. The outlook for Post Malaysia is very similar to GDEX, as mentioned above, that we believe the parcel delivery segment will continue to be the winner even post-pandemic. Currently, Post Malaysia is trading at 1 ringgit and 3 cents as at 25th of January 21 with a negative PE ratio due to its negative earnings since 2018. Started in the third quarter of 2018, Post Malaysia has 9 consecutive negative earnings. The positive note about their financial is that their net tangible asset is 70% higher than its current price. Its debt-equity ratio is 0.4 and they sit with a cash reserve of 287 million ringgit. Rank number 9 is TASCO BERHAD with a market capitalization of 778 million ringgit. TASCO BERHAD is engaged in business as a total logistics solutions provider. The company segments include air freight forwarding division, trucking division, ocean freight forwarding division, and origin cargo order and vendor management division. On December 8, 2020, TASCO has entered a Memorandum and Understanding MOU with GDEX. The objectives of the MOU are to leverage and utilize each other's strengths to develop and organize joint marketing activities utilizing the network and capabilities of both entities, and also to advance the development of seamless connectivity of e-commerce and other social commercial platforms with logistic fulfillment services. It also enhanced knowledge sharing with a view to foster improved coordination and synergies. Essentially, the MOU is vital point for TASCO to improve its logistics services and be able to cater for more complex logistic demands from its customers. TASCO has shown unprecedented growth amidst the current pandemic operating environment, and we expect the group will continue to perform well in the second half of 2021. This is premised on the elevated air freight charge, which we foresee will remain elevated due to the persistent limited availability of international flights. In addition, the group has shown strong earnings growth underpinned by its air freight forwarding AFF division for its international segment and the cold supply chain logistic CSC division for its domestic segment. So the international segment saw a revenue of 117.3 million ringgit for the first 6 months of financial year 21, which was 60% gain year on year, and the domestic segment saw an increase of 8% of year-on-year, which is equivalent to 62.1 million ringgit. Overall, the 6 months financial year 21, the group recorded revenue at 408 million ringgit, which is 10% of year-on-year gain. Currently, TASCO is trading at 3 ringgit and 89 cents as at 25th of January 21 with a PE ratio of 46.2, ROE 3.8%, profit margin of 2%. We believe the current valuation is on the high side, and given the collaboration as mentioned above, earnings should be improving. Rank number 10 is the Malaysian Bulk Carriers BERHAD or MAYBULK with a market capitalization of 460 million ringgit. Malaysian Bulk Carriers BERHAD is a Malaysia-based investment holding company. The company is engaged in international shipping. The company's segments include bulkers, tankers, ship brokerage and management, and investment holding and others. We like MAYBULK is because we believe that the dry bulk market is bound for a sustainable rebound. The industry projections for global dry bulk trade growth in 2020 are moderate. Iron ore trade is expected to grow around 0.4% in ton miles, supported by the return of some Brazilian volumes and restocking in China. Global soybean trade is expected to grow by 4% to 153 metric tons, after zero growth in 2018 to 2019. Grain trade is seen rising 2 to 3% amid improving U.S. trade relations. In addition, increasing Chinese coal imports and strong grain exports from the US have fueled the dry bulk market at the start of 2021. Average Kamsarmax, which is a form of a large ship, earnings over the first 3 weeks of 2021 has hit $14,100 per day, the strongest start of the year since 2014. Moreover, since March 2020, the Baltic Dry Index has seen rising steadily from 385 in March to the current 1,540, which is an increase of 400%. Currently, MAYBULK is trading at 46 cents as at 25th of January 2021, with a PE ratio of 11.3, ROE 12.2%, profit margin of 21.2%. The company has seen their earnings recovering from the deep loss in 2015. The quarterly earnings are weak, but we are seeing slow improvement over time. The above analysis is for information purpose and we do not initiate a buy or a sell call. At the point of recording, we do not hold any of the stocks mentioned in this video. Thank you.